You can reach us here at colattutorlab@uab.edu, or you can set up a Skype session with us at colat_tutor, and we can tutor you through the Skype account. This is going to focus on Chapter 7, Accounts and Notes Receivable. In previous sessions, I've worked a lot of problems in Excel. However, due to Chapter 7 being primarily conceptual and definitions, no real problems to work that were not covered in chapter or homework, primarily new conceptual items and definitions. So Excel will not be used for this chapter. We're going to go back to Word. Chapter 7 concerns itself with accounts receivable and notes receivable. Due to the prominence of accounts receivable through the preceding chapters, we're going to concentrate our efforts on the new concepts and new methods of accounting for bad debts and a previous unused account called notes receivable. Bad debts. When a company extends credit to its customers, there is a reasonable assumption that some small percentage of its credit accounts will be uncollectible. This is known as bad debt. There are two methods for writing off uncollectible accounts. One is the direct write-off method, and the other is the allowance method. Under the direct write-off method, when an account receivable is judged to be uncollectible, it is written off immediately. No attempt is made to predict bad debt expenses. The journal entry will look like the entry I make below, and it will be charged to the specific company that incurred the bad debt in its accounts receivable. Bad debt expense is being debited $500. As we all know, expenses are increased by debiting them. And then we are going to credit accounts receivable for the JW company, $500. This is the entry to record the write-off of an uncollectible account. Under the direct method, when you are recovering a bad debt, sometimes you write off a bad debt under the direct write-off method, and you are able to collect the previously considered uncollectible account. When that happens, you have to A, reverse the entry that was made to record the bad debt expense, and then you have to make an additional entry to record the collection of that account. The entry will look like what I have put below. Accounts receivable JW company is being debited for $500. That increases it. That reverses the entry from before, and bad debt expense is being credited, which reduces the expense. This reverses the previously written off account. You then have to record the collection of $500 cash that you debit, and you credit your accounts receivable for the JW company for $500, and that records the full payment of the JW company account. Allowance method. Allowance method matches the estimated loss from uncollectible accounts receivable accounts against the sales that help produce the associated accounts receivable. What that means is that the sale that created that original accounts receivable is going to be the one that's going to be associated with the accounts receivable. Under the allowance method, we have what is called an allowance for doubtful accounts. This account is a contra asset account. A contra asset account is the opposite of an asset account in that it maintains a credit side balance versus the traditional debit side balance of a normal asset account. Based off a company's previous history or experience, it makes an estimate of how much of its accounts receivable will be uncollectible. It makes an entry to record this, which will look like my next entry below. Bad debt expense, $2,000. Allowance for doubtful accounts, $2,000. They are debited and credited accordingly. As we talked about, expenses are increased by debit entries, and a contra asset account is increased by making a credit entry. The allowance for doubtful accounts has the effect of reducing the accounts receivable account to its estimated realizable value. That is the expected proceeds from converting an asset into cash. It will look like this in your current assets. Current assets, accounts receivable, $20,000, less allowance for doubtful accounts, which is from up here, $2,000, which we would have an $18,000 balance in our accounts receivable. Writing off a bad debt under the allowance method. When specific accounts are identified as uncollectible, they are written off against the allowance for doubtful accounts. Remember, this is a contra asset account, so a credit increases it and a debit decreases it. Make sure that you remember that. So for the allowance for a doubtful account, we're writing it off, $500. We're deducting $500 from accounts receivable for the JD company. This write-off does not affect the realizable value of accounts receivable. See the entry that I make below. Accounts receivable, $20,000, less allowance for doubtful accounts, $2,000 gave us a balance of $18,000. That's before the write-off. After the write-off, it's accounts receivable, $19,500, because that's the $500 that we deducted from the accounts receivable, less allowance for doubtful accounts, $1,500. Remember, it had a $2,000 credit side balance. We debited it $500. It now stands at $1,500. We still have $18,000 as our estimated realizable value for accounts receivable. As you can see, the accounts receivable did not change its balance after the write-off. Prior to the write-off, $18,000. After the write-off, $18,000. Recovering a bad debt under the allowance method. Much like the direct write-off method, you would reverse the entry to record the bad debt and then account for the previously charged off account. See entry below. Accounts receivable, JD Company. We are debiting it properly, $500, because we are recovering it. And we are replacing the $500 in our allowance for doubtful accounts by crediting it, because again, this is a contra asset account. As we discussed earlier, contra asset accounts carry a credit side balance instead of a debit side balance. We would then, this reverses the previously written off account from here. So that reverses that, and then we would properly debit ourselves with $500 cash and credit JD Company's accounts receivable account for the $500. This records the full payment of the, that is supposed to be JD Company. My apologies for missing that. Notes receivable. Pay attention to Exhibit 7-7.14 and Exhibit 7.15 on pages 312 and 313 respectively. They explain everything you need to know about notes receivable, and the definitions on those pages explain it very well. What you're basically going to find when you go to Exhibit 714 is a picture of a promissory note with its interest amount, how much the note receivable is for, on this case it's $1,000, and then it will show you how that those are counted for, and this will show you how the interest rates are computed. I'm sorry, it will show you the entries for the maturity date comparisons. This really concludes chapter 7 because, again, there's not much need for elaborate calculations. I believe that you more than adequately cover those in your homework and in the chapter work that you've seen. So this is primarily a conceptual and definition chapter. Of course, there is some work to be done, as I've shown here, with accounts and you having to properly recognize what to debit, what to credit. But those are things that at this point in chapter 7 you should have well in hand. Again, my name is Dennis Brooks. I am a graduate student here at the COLAT Business Lab. You can reach us at colattutorlab@uab.edu, or you can arrange a Skype session at colat-tutor to arrange a Skype session tutoring. Good luck on your chapter 7, and that will be the end of this.